Hi everybody, welcome to the Middle Class Investor. Thanks for joining me this week. This is Seth Martin, your host. And boy, we had an interesting week in the market toward the latter part of the week. I went on vacation for a few days and boom, all kinds of stuff was happening. What I've got up on the chart here, it's quite a bit of data. We go back to 2000. And this line up here that I've drawn, it connects the 2000 highs, the 2007 highs, and then the most recent highs. And I'm going to zoom in a minute, and we're going to show that on the Dow we actually kind of came outside of that upper trend line, which is kind of interesting. But what's more interesting is how this line, you're connecting all these points and they match up. You can even see here, boy, it just touched. And anyway, it to me, it's a very interesting thing. And we're going to talk a little bit briefly today about economic indicators and news. And there's, especially with the market selling off, is it a bubble? Is it this? Is it that? There's a lot of confusion in the marketplace, and you're gonna hear a lot of news, especially as you start to get more and more engaged in what's happening. It'll get louder and more dramatic and more concerning for politicians, for the media, and then eventually for each one of us that have 401ks and IRAs and whatnot. But anyway, I just wanted to show you how this line connects, and then we'll zoom in. Actually, I want to go to a weekly first. I'm going to zoom in on a weekly because what I want to show you is how we spent 1, 2, 3, 4, 5, 6, 7, 8 weeks above this red trend line here, and then this week we blasted through it really hard. And you can see here I've got a support box below this low right here, which is a meaningful low, but the more meaningful low is this one down here at 16,000, which is, a pretty dramatic drop of 1,000 points on the Dow Jones Industrial Average. In fact, this line that I've got drawn right here, this 16,434, is where the Dow Jones Industrial Average began the year. So we're still up on the year as of today, but earlier this week we were actually at break even when we hit this line. So now, I would say that most of your 401ks and your IRAs are not going to track the Dow as closely as they track the S&P 500, but I just think that's an interesting piece of information. So let's zoom in a little bit on the Dow, and you can see here's this low that I've drawn here with this support box. And so what we could expect to happen is the market to continue to pull down into this support before we get some sort of bounce. Now, it could pull down into this support, we could bounce, and then we could draw another box down here for this low right here, and we could put that right about, sometimes you want to put it just below the lows, and we could put it right here. So the market, let's zoom in here, and we will do a little drawing. Because remember, the purpose of this webinar or these YouTube videos is to help you make a decision, a good decision about what to do with your money. We don't want you to make a poor decision based on emotion and fear and things like that. So I think so the best thing to do is have a plan. What kind of plan are we going to put together? So I think next week you can expect the market probably come up a little bit and then meander its way down into this support box. Now, this should hold, okay? This should hold as support. But if this is a larger sell-off, I mean, if sometimes, I think we talked about it before, but the wedge, once we break out of the wedge, the sell-off, as I've talked about before, can be quite dramatic. So it tends to retrace fully the wedge. But we've kind of got different things happening on the Dow and the S&P, so I want to talk about them a little separately. But we should expect the market to bounce a little bit and then to sell off into this box around 16,300. So let's look for that to happen next week. If it goes through this box, and I mean closes down below it, say around 16,200, then you can expect the market to go all the way down into this 15,950 area or 16,000. That'll be the next level of support. I'm not sure which markets you guys are used to looking at, if it's more of the Dow or more of the S&P. The S&P is the boss. It's the one you should be looking at more closely. But sometimes, the Dow's in the news more often. Now on the S&P, it spent a little less time outside this box. Well, I don't know. It was above the box this week, but then below. So total above, you have this week. So 1, 2, 3, 4, 5, 6 weeks above, and then this week it just totally lost it. And we've talked about the phenomenon here in this rising wedge. So it's hard to say if this. It's interesting how this line. I mean, you've been watching my videos now for a while now. Here, let's put it on a 3-month or a 6-month. Look how this line. Well, I zoomed in too much. Look how this line held right here. Isn't that interesting, given how long the line has been on the chart? And that's the thing about technical analysis. It's and I'm going to talk about economic indicators and fundamentals here in just a little while, but it's really interesting how you really just need to kind of look at a chart every now and then. Understand what you're invested in and look at the chart. Because this market came all the way down, almost touched this line before the bulls took it back up. So the bears, it opened here. It opened here. It went all the way down here. The bulls pushed it all the way back up here, or maybe it was up here first. It might have opened here, pushed up, and then pushed all the way down, and then back up to here. So the bulls kind of got control late in the day, but isn't it interesting how that line kind of held as support? I'm talking about this line right here. So on the S&P, we might look for kind of a similar thing to happen. You might look for the market to come up, with a bounce, maybe bounce into this area, maybe this old support box, and then kind of come on down into this area right here, something like that, into this support box. And then this whole move should be over. I mean, that's what I'm expecting to happen. I'm expecting this whole move to be over once we bounce and meander our way back down into this support box. Now this could take the rest of next week and maybe half the following week, or it might take the next 2 weeks for this to play out. It's really hard to say. But then what we're going to do is we're going to be looking for, and this is the part that I want y'all to be very aware of. This is going to be part of the plan. If the market comes down into the support area, like I'm going to draw it a little bit shorter this way so that we have a little bit of room over here. If it comes down into this area and this support holds, what we're going to look to happen is we're going to look to see a move back up. It's going to be a very strong move, okay? It might look something like that where the box, tends to hold, and you might get a move all the way back up into this area, which is, what is that area? Not sure what that area is. Oh, that's on the S&P. That's like 1965 or so. In fact, I'm going to show you guys a tool that you can use. Probably should have found you a charting tool. Next time I do a video, I'll put on a charting tool that you can get free off the internet. A lot of times what happens is when the market moves either up or down in a large fashion like this, you get a retracement into this zone right in here, somewhere in between 50%, which would be 1953.88, and 1875. So, right in the middle here, between, let's just call it between 1960 and 1970. So we're going to look for the S&P to retrace into this 1970 to 1960 area. Now, if it does, so let's zoom back in. If it does, let's say it retraces something like this, okay, something like right up into here, and then starts to turn down, okay? So it can't make a higher high. It's not going to go and retest these highs. This right here is a key spot. This is where you need to be making a decision, okay? I'm not saying it has to do this, okay? It could do this and maybe make a move up and then keep going. But here's the deal. If it turns here and starts to come down, this is a great place to get out. And if it turns back up and you think it's bullish, you can always get back in. But this move, this next move down, after you've had an initial move and a correction into that move, this move tends to be very, very strong. And you do not want to be in the market if this is the next move, okay? In fact, if it doesn't do this pretty quick, if it doesn't move in this direction fairly quickly, you could just turn around, get back in, and expect it to go higher. But it's a pretty good reward to risk in getting out or stepping to the sidelines right here, because this next move is usually a doozy. So just keep that in mind. Obviously, it's your money, it's your account. You do what you want to do. But again, the purpose of these videos is to help you make better decisions, and that's typically what the market will do. So I'm just telling you what the market typically does. Whatever happens, if you get a break, to me, this box right here, and if not this one, this 1870 area, these are critical areas. These are large trend reversal locations. So if we close below, say, 1890 down to 1840 or 1830 right here, we've got a longer term bear market that's setting up. So keep that in mind. Let's look at the volatility. The volatility spiked pretty hard the other day, or this week rather. I showed you a longer term chart of volatility, and we had this line in here as kind of a median, that when we get above this line, the market starts getting a little bit dicey. Let's look at the euro US dollar. The euro looks like it's the euro basically looks like our stock market. So although it looks like it started going down a little earlier than our stock market. But this makes sense because the dollar, let's see, we can look at an ETF for the dollar. The UUP, excuse me, the UUP is an ETF, an exchange-traded fund for the dollar index. And you can see here the dollar pulled down. Looks like it made an important low, made a move off the low, pulled back to a higher low, and is moving out pretty strong. So if you run a correlation between the stock market and the dollar, pretty much as the dollar's gone down, the stock market's gone up. It's only been the last couple of years here that it's been kind of in a trading range. You can see here it came into a low, and all this price action is above this low. So I'd say this low is pretty strong. It looks to me like this is all corrective. All this stuff right in here. So it looks like this was a major correction, and then this has all just been chopping higher. So we'll see. I mean, you know, it makes a lot of sense that if our market sells off, the dollar is going to strengthen, because what happens is the dollar is perceived as being, well, it's not just perceived, it's the world's reserve currency. So what does that mean? That means that, well, years ago, all, you know, currency, especially the dollar, used to be backed by gold. Well, after World War II, we were pretty much the dominant financial force in the world, and we said that the dollar was as good as gold, and it was backed by gold. So we would store the world's gold, and for purposes of efficiency and just, you know, ease of doing business around the world, people would just trade in dollars. The dollar would be the reserve currency, so you could always trade whatever you had for dollars, and then you could, if you wanted to, you could take those dollars and cash them in for gold at the New York Fed. I think is where they stored all the gold, that in Fort Knox. So then, of course, August 25th, 1971, the Nixon administration took us off the gold standard. There was the reason that was happening. Just a little history here. We were involved in the Vietnam War. We had major entitlement programs that were being launched. The war on poverty, Medicare, Medicaid, things like that were being passed through Congress, and parts of the world, namely France, started thinking to themselves, hey, you know, these guys are spending a lot of money, and we've got a lot of dollars. Let's go ahead and cash some of these dollars in for gold. And of course, France was trying to cash their dollars in for gold. There was a run on the bank, so to speak, except it was gold. It was a run on the gold bank. And the response was, well, we're just going to temporarily close the gold window. Well, temporarily turned into permanently, and now we have currency backed by nothing all over the world. So, but the United States and the dollar still it has the privilege of being the world's reserve currency, which means that it can be spent anywhere. You can spend dollars anywhere for anything. Some things have to be bought in dollars, like oil. Although you see Russia and China today making agreements to buy oil and energy and commodities and things like that from each other using their own currencies without, they're just cutting the dollar out of the deal. So there's some interesting things happening around this world reserve currency, but it makes a lot of sense that if you have some sort of financial panic, people are going to run to the dollar because there's some perceived safety there. So that's enough of that. You can read more about that you can probably find out a lot about it just on Wikipedia or something. But okay, so let's go to the interest rate. The interest rate is, to me, it's one of the most interesting markets this week because it didn't do as much as you might think it would, although today it sold off quite a bit. But during the big sell-off in the market the day before, you can see here, see, this was the day before, this was today, so this is Friday, August 1st, and this is Thursday, July 31st. So you can see that that the interest rate, the yield on the 10-year, it had a pretty big sell-off today, 2%. That's a huge move, by the way, in the bond market. So we could experience another low below this box in the Treasury yield market. The reason I'm not expecting it is because, golly, I'm going to have to go back a little bit further. Let me go back 5 years. This August, we've talked about this before, but in 2012, around July 2012, the yield, we'll see what the low was. The low yield was 1.394%, and that low obviously is held. But if you use Fibonacci and you go from low to high, we've had a 38% retracement, almost exactly. I mean, this bar right here is a 38% retracement. Now, in a strong trend, a 38% retracement is very common. 38 and 50 are very, very common. So this could come down here into the 50. The problem with coming into the 50 is there's not a lot of support here. So to me, if it comes this far, then it's kind of come all the way down to here. But it could be that the 38% retracement will hold. The problem for you guys out there as IRA, investors and 401k investors is if you have bond funds and it meanders its way down into here, that's great. You're going to make money. You're going to make a lot of money. And it makes a lot of sense that if the stock market sells off, the bond market would move higher, thus rates moving lower. But there's a lot of angst in the market around all these QEs, these quantitative easing programs that the Fed has been involved in. So I'm opening up a can of worms here, but basically what the Fed has been doing is the Treasury creates a piece of paper, and it's called a bond. And then the Fed normally runs these things called open market operations, which is like a market, okay? And investors come in there and they buy the bonds, and then that creates dollars that flow into the Treasury. Now, as this happens, as the demand for Treasuries goes up, the yield goes down. But what's happening is the Fed normally just runs these operations, but they've been coming in as a buyer and buying these products in an effort to keep this rate from going higher. And you can see that they haven't had a whole lot of luck. I mean, all this was QE. All this stuff were all the various QEs, and look, rates just went higher, 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 higher. Now they have pulled back here, but QE started way back in here. So it's clear the Fed, is not in control of these interest rates. In fact, the Fed doesn't control this particular interest rate. The bond market does. But the problem is now the Fed has like $4.5 trillion worth of these treasuries. Well, eventually they got to sell them. And the question is, who are they going to sell them to? When the U.S. has got, going on $20 trillion in debt, who's going to buy the 10-year treasury? Well, the answer is pretty much nobody. So what's going to happen is these yields are going to rise. As the bond prices fall to try to find a buyer, these yield prices are going to rise, rise, rise. And when that happens, your bond funds, if you own bond funds in your 401k and IRA, you're going to lose a tremendous amount of money. Because again, if this is the first move and this is the correction after the first move, that next move is very, very large. And let me just demonstrate that real quick. I'm going to have to zoom in a little bit, but I want to show you what I mean by that first move down. So let's zoom in here. Here's our first. Let's do this with the little annotation tool. If I can get everything in there. Whoops, I'm not going to be able to get everything in there. Let me zoom back out. And let's do this. And then do this. See if I can get everything in there now. Close enough. Okay. So what I'm talking about is this is the first move down. This was the correction into the first move down. And you see how big this is? See how big this next move is? This is what I'm talking about. Now, the difference between what we just looked at right here and the bond market, let's go back to the bond market. Let me go back to the 5-year. The difference between these two charts is just time. So, and the size of the move, okay? This right here, this whole move right here is a huge move, and this correction is fairly large, okay? Just imagine what this next move up could look like. I mean, it could be very, very large. And so this is where the real problem is in our financial system. It's all this debt that we have at very, very low interest rates. As interest rates move higher, the debt is going to become more and more difficult to service. And it's either going to have to be defaulted on, or the dollar, or the Fed's just going to continue to print dollars and destroy the value of the dollar. Now, how all this is going to play out, we don't know, which brings me to my next point, gold. Gold, I apologize, but I'm off of the screen here, but gold started, its high was at 1923.70, which is in this area up here, off the screen over here to the left. And you can see we made a move down, then we had this big move, and we've been consolidating. And I've talked about this before, but this pennant, or this triangle pattern, is a consolidation pattern, or a trend continuation pattern, which means if the trend is down and we're consolidating, then we've got another leg down. Maybe, $1,000, $1,050, I don't know. We'll be able to get a better handle on it after this moves out of this pattern. But it looks like it could go for, a while longer, maybe to the end of the year before it actually breaks out of this pattern. But we'll keep watching it here on the Middle Class Investor. Now, something I alluded to earlier, we talked, it was kind of back to the technical analysis discussion. One of the reasons I wanted to do these videos is because, let me just show you here. The ISM Chicago PMI number came out, I think, a couple of days ago. But I want you to see here, this is a pretty important indicator. But you can see in June, it says Chicago Business Barometer was down 2.9 points to 62.6. So that means the month before, in May, it was at 65.5. You can see right there. Look at what happened in July. Chicago Business Barometer down 10 points to 52.6. The lowest since June 2013. And I follow these things pretty closely. I can't remember a time when it dropped 10 points in 1 month. This is a pretty big move. So there's something pretty drastic going on here. Now, just to let you know about this indicator, anything below 50 is considered contraction in the U.S. economy. And I don't know all the details about this indicator, but it's widely watched, and it's an important indicator. But something about indicators, I want to make a point about indicators. These are all the economic indicators. I went to the website. Now look at the latest update. This is all just either August or late July. I mean, look at some of these. You'll know: light vehicle sales, manufacturing PMI, personal income and outlays, commercial paper, economic and financial blah blah blah, Chicago Business Barometer, employment cost index, money stock measures, ADP and employment, business employment dynamics, gross domestic product, Case-Shiller home price. I mean, some of these you've heard of, I'm sure. But look at all these. These are all economic indicators. Now, assuming you actually followed every one of these every month, how are you going to make a rational decision about what to do in your 401k or IRA? It's impossible, okay? The fact is, you don't need to know any of this. Just X right through it, okay? What you need to know, or what you need to become comfortable with, is this: the way the trend moves and the way the price action moves. It tells you everything you need to know about what's going on with your investments, because this is massive amounts of money changing hands. And when you see a move like this or like this, it's telling you something. Now, it could be that it's telling us just like what this is. This made a move down, the next move was big, but then it rallied back up and kept going, right? So what we're going to watch for, though, is a break out of this pattern. That's why these lines are so critical. So if you're in the market right now, there's nothing to do except sit tight. But what's likely to happen is we're likely to get a bounce, likely to break out of this pattern, retest the pattern, and then move down. So once this breaks out of the pattern, it's like 93% effective of coming true. So that's why I'm saying if we come down here and we break out and then we retest back into the pattern, yeah, you could wait and see what's going to happen. But once it's broken out and closed below here, it's about a 90% effective pattern. And the pattern tells us that we're going to get down here somewhere probably below this low here, probably 1720 or so. So you don't have to believe it, but just keep watching the videos and let's look at it together and let's rationally think through what's happening in the market and let's make a good decision. And maybe your decision is, hey, I'm well diversified. I'm going to power right through it. I went through the last one. I'm going to go through the next one. Maybe your decision is, hey, I like what Seth's saying and it makes a lot of sense to me, and I'm going to follow along with him, and I'm going to step to the sidelines if this thing turns into a major bear market. So with that, I think I'm going to end this week's video. We're on YouTube. These videos are on YouTube at Middle Class Investor. I usually pop out a tweet, I guess is what it is, from Twitter, and you can find me there so the little @ sign, Investor Class, all one word. Those are the only two places I am right now. If you go to the YouTube channel and you set yourself up an account, you can subscribe to the YouTube channel. You can comment. You can ask questions. We can have a dialogue on there, whatever you want to do. So send links to your friends, your family members, people that are interested in preserving their money, their hard-earned money, and their investments. And let's just let's keep coming back, and we'll weather this thing and we'll get through it. But we're getting to a place here where I think we're going to be needing to make a decision soon, and I think it's very important that you visit the videos, or at least find somebody that can help you navigate what's going on here. Don't listen to Jim Cramer. Don't listen to CNBC. If you like watching it for entertainment, that's fine. but don't try to make heads or tails of any investment advice there. There's no investment advice. There's no market advice there. It's just a bunch of people, they're reporters basically talking about the market. So they really don't have any specialized knowledge about the market. So don't listen to them. All right, well, that should do it for this week. Again, if you have any questions or comments, post those on the YouTube channel. We'll talk back and forth. If there's something in particular I should be talking about on this, I'd love the feedback. Love to hear from you guys. All right, we'll see you next week. Thanks for visiting The Middle Class Investor. Take care, everybody.